Numbers are absolute. They do not bend. Yet leadership misinterprets them, collapsing companies that appeared perfectly healthy on a profit and loss statement. There is a persistent belief that profitability guarantees survival. The data suggests otherwise, as highly profitable companies go bankrupt, while those running heavy deficits can operate continuously for decades. This headline captures the central paradox of financial leadership. Profit exists as an accounting metric, subject to interpretation and timing rules. Cash exists as physical oxygen. This box on the left explains why high revenue fails to ensure survival. A company can record massive sales on an income statement, but if those clients have not yet paid their invoices, the bank account remains empty. This section highlights how loss-making companies survive. As long as you maintain the liquidity to meet immediate obligations, the business stays alive regardless of the accounting deficit. Top-line growth often receives the focus in board meetings. However, rigorous cash discipline serves as the actual mechanism that determines corporate longevity. The finance function operates as a structural engineering challenge, requiring systems to manage the physical pressure of capital moving through the business. Focusing exclusively on profitability creates an illusion of health, masking the true operational state of the company. Building resilience requires mastering cash dynamics first. Cautionary: scaling up is one of the most dangerous periods for a balance sheet. The third box here shows how growth destroys liquidity, actively draining capital by requiring investment in infrastructure and payroll long before revenue returns. Founders must track 3 metrics to survive expansion. Unit economics measures direct revenues and costs, while cash runway tracks the exact months before depleting reserves. Finally, working capital cycles are the time lags between spending cash and receiving it back from customers. As a business scales, cash trapped in this cycle expands. Money flows out to secure inventory and hire teams, creating a delay where central reserves drop. Increasing the velocity of operations simply accelerates the timeline to a liquidity crisis. Founders must understand these cycles at a strategic level to maintain control. As this text states, finance literacy is leadership maturity. Rapid growth acts as a structural stress test. Proactive liquidity management prevents expansion from turning into an existential threat. In the early stages of a startup, leadership often relies on informal processes and agility. As the organization scales, that informality becomes a significant liability. Scale does not iron out operational wrinkles, it amplifies them. Minor process flaws, like informal documentation, transform into critical audit findings. And small compliance gaps, often ignored during early growth, eventually result in expensive legal and financial penalties. A common failure is ignoring the segregation of duties, increasing the risk of catastrophic error. This list details why capable teams fail: weak reconciliations and informal documentation. Ultimately, rigid governance systems prove superior to individual talent when managing a growing enterprise. Scaling a business without these rigid structures essentially engineers a collapse. Systems provide the integrity required to support the weight of growth. Reconciliation serves as a primary leadership metric, dictating organizational health. It involves ensuring internal financial records match external bank statements perfectly. When accounts fail to reconcile, the issue is rarely a simple math error. Unreconciled balances signal a systemic lack of ownership and a failure in review discipline. High-performing companies operate with a strict standard. Every account must be reconciled monthly, without exception. The external audit acts as the ultimate stress test for this internal discipline. This slide frames the audit as a mirror, revealing the organization's hidden vulnerabilities. If audits are painful for the team, the underlying financial architecture is fragile. Year-round operational discipline is the only effective way to minimize this audit friction. Leadership must embrace audits and reconciliations as diagnostic tools. They identify exact structural weaknesses, allowing the team to reinforce the system before a crisis occurs. Compliance provides a strategic shield, protecting cash, reputation, and the personal liability of directors. Treating compliance casually during early growth builds a significant debt of liability that eventually comes due as the company matures. The architecture of financial resilience relies on 3 pillars: cash discipline, governance systems, and reconciliation integrity. These icons represent the final strategic metrics founders must continuously monitor, specifically their debt obligations and aggregate risk exposure. Finance provides the structural framework that dictates whether a business has the strength to survive expansion. Strong companies are built on cash reality, governance maturity, and unrelenting leadership accountability. Developing this level of financial literacy is the hallmark of leadership maturity in any executive role. Strategic finance builds lasting resilience into the core of the organization, moving beyond the simple production of historical reports.